There's an old adage on Wall Street that the Fed tends to hike rates until something breaks. Well, something broke. In fact, 3 banks broke late in the first quarter amid growing banking stress. Hi, I'm Paul Delaney, a wealth advisor with Capital Endurance Group. I'm going to recap our portfolio positioning and briefly explain why we're positioned the way we are. We remain in quadrant 4 of our risk positioning matrix, the contraction quadrant. The contraction phase of the cycle is one in which we have central banks tightening monetary policy and a decelerating economic outlook. It's a time to keep our clients' portfolios safe as we potentially slide into recession and a bear market. We still have equity hedges in place with a neutral position in Treasury bond interest rate sensitivity. Let me highlight just a couple of the reasons why we remain in the contraction quadrant. To head off inflation, the Fed has been pushing up short-term interest rates at the fastest pace in history, from the lowest starting point in history. In this chart, you'll see this effect by the lines going almost vertical. Combining rapid rate hikes with a low starting point maximizes the damage to bond prices, and that in turn has contributed to 3 banks going under in Q1. Borrowing rates for home buyers and companies have skyrocketed. This is a big shock to the economy that has yet to fully play out in markets beyond moderating inflation levels. The FDIC recently estimated that at the end of 2022, US banks were sitting on at least $620 billion of unrealized losses on their bond holdings, which represents 2 years' worth of net operating income. Notice how, as the federal funds rate in blue in this chart has gone up, the losses in green have accelerated down to 200% of net income. But of course, that ignores the largest asset category on bank balance sheets, which are loans. A paper published in March 2023 by academics at Columbia, USC, Northwestern, and Stanford estimates US bank equity is actually $2 trillion lower than reported after adjusting for recent interest rate increases. Lower than expected capital levels, combined with high levels of uninsured deposits, places perhaps hundreds of other banks at risk of deposit runs, according to their analysis. This situation is likely to precipitate a credit crunch, whereby banks pull back abruptly on extending credit to maintain their financial stability. Credit is the lifeblood of any economy, so shrinking bank loan portfolios is really bad for growth. You can see from this chart that as bank lending standards tighten, that's the green line going up, commercial and industrial loans, the red line, top out and then plunge. I've highlighted that in yellow. You'll also notice as loans roll over, recessions tend to follow. As of February 2023, loans are rolling over. And yet the S&P 500 remains range-bound. Here you can see monthly price ranges for the S&P 500 where red indicates a negative monthly return, while green indicates a positive monthly return. Earnings estimates seem to be ignoring the dimming economic outlook. Here you can see Wall Street is estimating 2023 earnings for the S&P 500 at $201, while a 1991 style moderate recession could cause that number to fall to around $125. Even worse would be a 2000 style bust that could see earnings fall to approximately $91. At this point you might be asking, well, who cares if the bond market is flagging recession if equities don't care? The problem with that is that eventually equities do start to care. This chart shows the volatility indexes for equities, called the VIX index, and bonds, called the MOVE index. Really high levels of volatility in a market are usually associated with losses. You may notice big spikes in the VIX index in 2008 during the credit crisis, and also in 2019 to 2020 as COVID unfolded. Notice also that the bond MOVE index in orange tends to spike before the equity VIX index in blue does. We see this happening once again. A partial explanation for some of this divergence in Q1 between the bond market and the equity market has been put forward by macro analyst Alfonso Pescatello. He has estimated the 5 largest central banks collectively increased liquidity in the first quarter of 2023, shown as the green arrow in the chart, in contrast with the steady reduction of global liquidity since 2021, shown as the solid red arrow. In the US, an injection of liquidity was caused by the debt ceiling impasse in Congress, which forced the Treasury to spend down its cash while not issuing new bonds. It also lent hundreds of billions of dollars to banks to avert a banking crisis. The net effect was a boost to risk assets like tech stocks and crypto. But the drivers of this liquidity boost do look temporary. If that proves correct, the gains may be short-lived. I'd like to make two other observations before we wrap this up. First, the S&P 500 generally does not bottom before recessions begin. Second, the S&P 500 doesn't usually bottom before the peak in the 2-year Treasury yield has been put in for the cycle. Let me quickly show you what I mean by looking at past bear markets. In the early 1990s, the 2-year Treasury yield, the orange line, peaked before the recession. And the S&P 500, shown as the purple line, bottomed during the recession, which was represented by the grey vertical shaded area. Fast forward to the early 2000s bear market, where the 2-year Treasury peaked in May 2000, while the S&P didn't bottom until late 2002, well after the recession had concluded. In the Great Recession of 2008, the 2-year Treasury yield peaked in mid-2006, while the S&P 500 bottomed near the end of the recession in March 2009. If we examine the current cycle, we see that the current 2-year yield's most recent high was on March 8th at 5.05%, once again shown in orange. And in the absence of the US as yet being clearly and obviously in recession, we can logically conclude that the bottom for the S&P 500 is probably not yet in. That is, of course, if the cycle plays out in a similar fashion to prior cycles. We therefore remain in quadrant 4 of our risk positioning matrix, where capital preservation remains paramount. We urge clients to remain patient and hedged until we see the equity market price in the concerns expressed both in the bond market and the macro data. Thanks for watching, and we'll see you in the next video update.